When you have a weaker Australian dollar, we're a country that imports pretty much everything, particularly things like fuel. So a weaker Australian dollar means that for Australian consumers, buying petrol as an example, which is priced in US dollars, has become relatively expensive. And you run the risk, if you've got a weaker currency, of having something that as an economist we call imported inflation, and it's where you're bringing in stuff that's costing more and therefore prices are moving up. And I've got this level of trepidation, I suppose, in my mind that we've cut rates maybe a little prematurely, and we might start to see the embers of inflation get stoked again by that imported price hike that we're likely to see. And if that's the case, that is quite a significant problem, because central bankers don't cut this month, raise the next. They like to have big, slow, longer term trends with what they do. You know, if you cut interest rates a little bit early and then inflation starts to come back, you're under a bit of pressure to get it quelled before it becomes too much of a problem. You can't exactly turn around a month later and say, oh, we're going to put rates back up. You know, you lose all confidence in the market. Hey guys, welcome to this week's Money and Investing Show. This week we are talking about interest rates. We've seen some cuts both in the US and here in Australia. What is the impact? Who are the winners and losers? And more importantly, what do we expect to see happen over the next few months? As always, make sure you take plenty of notes, but most importantly, make sure you take plenty of action. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Olarenshaw.
Good to be here, Mr. B. Now, we're going to revisit a topic which we actually spoke about quite a lot last year. It was fairly topical, particularly as the US began their campaign, and that's interest rates, our expectations, and what it all means for markets, not just the stock market, but also real estate investments as well.
Such a pivotal thing. I mean, there's a huge amount of economic data that exists in the world, but the one that captures everyone's attention is interest rates, because ultimately it affects pretty much everybody.
That's right. And in Australia, not to date this podcast, we've just seen the first interest rate cut that we've had in a number of years. Great for many variable mortgage rate holders. Then also there's the argument of it being premature, which no doubt we'll discuss today.
It's interesting. There are only about 33% of Australians actually have a mortgage. So we're talking about something that affects 1/3 of the population, potentially in a positive way, and maybe affects 2/3 of the population in a less than positive way. So we'll take that angle as we go through too. But look, anyone that's been sitting under any level of mortgage duress, that cut in rates obviously is welcome. If you think about what it means in dollar terms, let's say you got a $500,000 mortgage, it's about $77 a week rate cut basically. So an extra 77 in your pocket to go spend or chip away and get your mortgage down, which would be the smart thing to do, get rid of some bad debt. So it's certainly some level of relief. Groundbreaking, game-changing for people, probably not, but it is a help in the right direction if you're one of the categories that are struggling.
Yep. So just to contextualize this, so we saw 25 basis points here in Australia in February. That's 0.25% adjustment to the cash rate. Now, theoretically speaking, doesn't always happen in practice. You should have got an email from your lender saying we're reducing your variable rate by 25 basis points. I can say thank you to mine. They did pretty much straight away. That's not always the case though. So just quickly, this might be slightly off topic, but if you're in a situation where your variable rate hasn't dropped by 25 basis points, should you be calling your lender?
I'd say so, and say time for you to pass on the benefit of that, because they usually pass on the rate cut straight away for savers and then delay on borrowers, and it just gives you that extra little bit of free jam which the banks love, and they're not averse to doing that. So force your lender to do it. Otherwise, find a new lender if they're not working with you. They're ultimately you're their customer and you're using their service, so they should be helping you.
So compare that to the US then. So in the United States, we had first interest rate cuts last year, around August, September, and we saw a little bit more of an aggressive campaign initially that's now slowed down. Here in Australia, we've had our very first rate cut in February. If we look at the US, firstly, AB, they had, I think, maybe 2 or 3 interest rate cuts, about 0.75% or 75 basis points. They're not really looking to cut rates anytime soon in the first half of this year, at least, is what the market expects. As we know, though, this is really all centered around inflation, which is going to change from month to month, right?
US is a very different kettle of fish. The economy is quite different there to that which we have in Australia. So I think we've got to explore why they cut earlier than we did. We were late getting to the party, raising rates. compared to the US, and we're probably, in my opinion, at least a little premature in cutting them. So the US got stuck in. They started cutting their rates last year. Inflation was subsiding significantly. The US economy was on track for a slowdown, and I think what they've engineered very smartly, Jerome Powell's done an outstanding job, is a very, not even a landing. It's not a soft landing. It hasn't touched down. It's a glide, and she's off again.
He's done a great job, hasn't he?
They've done terrifically well with it in terms of reading the tape and the timing of their decisions. But I think where they particularly did a great job was their ability to communicate what they were doing to markets. Markets hate uncertainty, and having a central banker which communicates very, very well and leaves no grey or ambiguous area that's open to interpretation. Look, we are cutting rates by 15 basis points is the speech, and that's what happens. You can't misinterpret it.
That's right.
So they've done a pretty good job there. The net effect for that, of course, in when we look at the US, I mean, that economy is rumbling. We've got a new president. It's very much America first. And, I can quite foresee that the US economy is going to enjoy a gold rush over the next couple of years on the back of some of the legislative changes, some of the changes that are anticipated in the tax space, and just through the inertia that the economy really has. That's how I see the US. It's a little bit different here in Australia. So
the intrigue, you've got me now.
Lean in and listen, because, we know that we were very late getting to the party. We also, in the form of, dare I say, Dr. Philip Lowe, who was the previous RBA governor, had someone that was manifestly incompetent. And I say that insofar as his ability to communicate his thought pattern. Remember the quote, there'll be no interest rate rises until 2024. Everyone took that on face value, that there'd be no interest rate rises till 24. In fact, we saw a whole series of them through 22, 23.
That's right, he did say that. I forgot about that.
So he's subsequently replaced with Michelle Bullock. And I think, in all fairness to Michelle Bullock, she's done a pretty good job insofar as she's really dug in from a political perspective. I think she's been under enormous pressure as Australia's moving towards a general election to cut rates, to say we've got inflation under control. And she's dug in to an extent, and I think quite potentially may have folded on this decision. I think it's slightly early, to be perfectly frank, as to whether it's the right time to cut rates. It's certainly going to help the incumbent government from the electioneering campaign, because you can say, look, inflation's under control, rates are being cut. They've been cut once. I don't think we're going to see another cut for a little while, because central bankers like to see the impact of their decisions before they make further decisions down the line. But also, I don't think we also had the ability within the Australian economy to digest the full impact of what we've seen with our weaker dollar. So the Australian dollar versus the US has really come off quite significantly this year. And what is the impact of that? Well, when you have a weaker Australian dollar, we're a country that imports pretty much everything, particularly things like fuel. So a weaker Australian dollar means that for Australian consumers, buying petrol as an example, which is priced in US dollars, has become relatively expensive. And you run the risk, if you've got a weaker currency, of having something that, as an economist, we call imported inflation. And it's where you're bringing in stuff that's costing more, and therefore prices are moving up. And I've got this level of trepidation, I suppose, in my mind that we've cut rates maybe a little prematurely, and we might start to see the embers of inflation get stoked again by that imported price hike that we're likely to see. And if that's the case, that is quite a significant problem, because central bankers don't cut this month, raise the next. They like to have big, slow, longer-term trends with what they do. And if you cut interest rates a little bit early and then inflation starts to come back, you're under a bit of pressure to get it quelled before it becomes too much of a problem. You can't exactly turn around a month later and say, we're going to put rates back up. You lose all confidence in the market. And that's why I think, possibly this one for Australia, maybe a little bit premature.
Yeah, one thing I can say is at least we've taken some lessons from the US. So, the RBA changed its format for interest rate decisions quite a lot. It used to be the first Tuesday of every month. It was one day followed by a statement. The US, for example, is a 2-day policy meeting where they can have some good time of discussion, announce the interest rate change, and then have a full discussion about it.
How much can you talk over 2 days or one?
Wow, central bankers, they can talk a lot. Anyway, we've adopted that.
Is that rhyming slang?
Yeah, something like that. Now, we've adopted that, which I think has been a good change, and has fared quite well. Question I've got though, AB, or at least a point of discussion: interest rates going up and down. How does that impact investments? Okay. So, for our listeners out there, stocks versus real estates. Let's take interest rates going up.
Okay, interest rates going up. Obviously painful if you've got a mortgage as a primary place of residence, your residential, your home. Not such an issue for landlords, because you can pass the rent increase on, or the cost increase onto your tenants through a rate hike, which a rent hike that we've seen plenty of. Where it sort of really helps are people that are savers, people that are retired, because you're obviously getting more interest on your money. Bond yields typically move up when interest rates move up. So if you're a retiree where most of your income comes from bonds, typically, you've got the ability to enjoy something of a pay rise. Also, if rates are moving higher, it's not so much that the rates are moving higher, it's why they are. So if you've got inflation in your economy, it generally means your economy is pumping along pretty well, which is typically good for equity markets too. So real estate equities typically do well in that situation. Why? Because rates are moving higher, because the economy is stimulated and running hot. So real assets move up in value. Very crudely.
One thing though as well, if interest rates go up, does that then mean dividend yields also go up for stocks?
Absolutely.
Naturally, right?
So there's to attract people into the stock market, if you're risk-free rate of return, if we can call it that, holding cash at the bank, not quite risk-free, but let's say that's our assumption. To compete with that, then yes, company has to pay a little bit higher of a dividend yield to entice you to want to own shares, which are higher risk than cash, but therefore you're getting higher compensation too.
So higher dividend yields on your stocks, and a charging economy typically goes in par with raising rates. Yep. So all assets should be quite beneficial to invest in, right?
And within stocks there are winners and losers, of course. So if you've got tighter economic conditions because interest rates have pulled money out of the economy to service higher debt, things like consumer discretionary tends to slow down a little bit because you've got less spare cash at the end of the month to go spend. So there are winners and losers within the stock market, but typically, generally, the companies put up a dividend, good for investors, and the economy is typically pumping. That's why they've had to put rates up.
One thing we look at on the trading desk, I know, in times of rising interest rates is the company's debt level. So they've got higher levels of debt. Obviously, they're going to be more susceptible to interest rate rises, and the opposite would be true with low levels of debt. So what we found, for example, was small cap stocks, say take those on the Russell 2000, which is the small cap index in the US. That was a lot more volatile compared to the large caps, which are relatively insulated. I mean, some stocks, take the big dogs like Apple and Nvidia, don't really have any debt whatsoever. So interest rates to them means nothing.
That's right. And they're also deemed as a lower credit risk. So their cost of borrowing is much lower. Interestingly, in that situation, if interest rates move up, what you can often see are companies shift, and we're diving a bit deeper into balance sheet management here, which I'm sure will take you back to some days at the hallowed halls of Bond University. Companies will mix up where they're getting their funding from, whether it's debt to equity. So if interest rates are moving higher, debt becomes more expensive to service. So you want to reduce that level of debt. And one thing that companies will often do, they may do a capital raise in order to buy back debt and use that money to pay down debt and adjust the borrowing levels within there. Equally, on the other side, of course, you can often see share buybacks too, which as an investor are great because it puts a bit of a support under the business. So looking at interest rates and what it's doing to the company balance sheet structure, much deeper than anyone listening to this podcast probably wants to go, is something also that can shift around a little bit. The company raises money via equity rather than debt, issue more shares, which can sometimes slow the share price down a bit.
So what about property then, AB, particularly in Australia? I mean, a lot of our stuff revolves around property, right? Interest rates going up is a good thing or a bad thing?
Look, in theory, it's supposed to slow down the property market. In reality, it probably doesn't, because the issues that we've covered plenty of times in this room around the Australian property market are really supply chain and supply side driven. So there's a very limited amount of new supply coming to the market in Australia, and you've got a ready market of people that are buyers, and that pushes prices higher. So it's almost, I'm not going to say impervious to interest rates, but it's not the major factor. If you had a more normalized property market where there was plenty of supply, plenty of demand, and it was really an equilibrium and prices weren't on a charge, but just growing at a more normal rate than what we've seen over the last few years, then moves in interest rates very much will affect the appetite for investors. In the first instance, your borrowing ability is reduced because it's a bigger loan to have to be able to service, which then stops prices ramping higher because you've got limited cash to go into that market to purchase.
Yeah, it's interesting. I, for example, had a chat with my parents not too long ago, and my parents, they didn't go to university, they didn't even finish high school. They're blue collar workers who've worked really hard in their life. They said to me the other day, Mitch, they're going to lower interest rates. That'll mean the property market will go up. And it was an interesting thought and conversation to have with them because, a lot of people think interest rates going lower means property prices should rise. But little do they realize that the only reason they're going to cut interest rates is to try and stimulate an economy that's maybe not as stimulated as it should be. What are your thoughts?
Yeah, look, I agree with the perspective of your mum and dad. Typically, lower rates are better for the property market. Why? Because it frees you up to borrow more, which then means you can chase price at an auction and pay more for it, which then propels prices higher. So, to an extent, that relationship is quite well correlated. I don't know that we've cut interest rates specifically to stimulate our economy. I do believe there's been a level of political pressure that's there because our economy is struggling, but that's because our largest trading partner is China. They too are struggling. We're also looking down the barrel at potential tariffs, which is not going to be a great thing for us either here. So a cut in interest rates, in terms of its impact, as I say, on property, very likely to see a little bit move to the north, which means that unfortunately property becomes even further out of reach for those people that are on the sidelines. So I mentioned earlier about a third of Australians have got a mortgage. That leaves a balance of people that have paid off their debt or a balance of people that are sitting on the sidelines potentially wanting to get into the market, and it's going to be much harder for them to do. Secondly, and again, this is quite specific to the Australian economy versus the US, which we'll revert to in a moment. We're going into an election cycle. We're about to see a big jump in Centrelink payments to people anyway that was timetabled in, which I believe goes probably within the next few weeks as we're recording this today, which means more money is pumping back into the economy. We're also seeing a government that's spending a fair chunk of cash as pre-election, let's call it salting the sample to try and get people keener to visit the ballot box. $2 billion to support the steelworks, for example, or the smelter down in Whyalla in South Australia coming out of the government. Don't know why. It's owned by a private company. They should be stumping up the dough to have that business running properly, and there should be incentives for the company to do that rather than the government have to pump it in. Another $8 billion in terms of changes to Medicare and the ability for people to access different services. There's a lot of new money flowing into the economy, and that sort of thing can be inflationary. So I don't know, a rate cut to stimulate an economy. We've got a government that's going to be and has been spending money like a drunken sailor. To me, that's and the risk, as we've alluded to, of imported inflation. I don't know. I think we might have jumped the gun a little bit here.
Interesting. So what are our expectations then moving forward? Next 6 months, what do we think is going to happen to wrap us up here?
I don't know that we're going to see another cut. I think we'll let that one sit, see how it goes.
In Australia, specifically?
Yeah, I don't think we'll see one in Australia. I was surprised that this one happened as quickly. I thought after March, it's come probably a month or two earlier than I would have anticipated. And I think the RBA are going to want to sit back and actually have a look and see how this has gone, notwithstanding the fact that the impact of the already weak Australian dollar is something that we're going to see impact on that overall inflation number, and that might temper the enthusiasm for cutting rates further. Add to that a colossal amount of government spending that's very likely to be happening, this side of an election. I think they'll probably sit back and watch it. Maybe not for 6 months, but certainly for a number of months. I don't expect this is one of a series of cuts that we're going to see in the immediate future. And again, it oftentimes, an economic policy has other impacts. We've suggested that maybe a rise up in property market prices, which keeps those people on the sideline further away from getting in the market. Another thing that's not overly popular with the electorate, but it's a consequence of that decision. Over the pond in the US, totally different kettle of fish. We've got, a election that's already in the rearview mirror. We've got policies that are laid out and an economy, I think, which is, going to be on the charge. And I think the Fed over in the US are likely to sit back and assess, okay, let's see what this expansionary economic policy really looks like. And if we see in the US things like productivity increases, which is one of the big things that's been spoken of, cutting out all the fat that we've seen very well documented in the media from a very overblown and ineffective deep state government, you might start to see that saving going into the economy and also becoming slightly reflationary. So I think the Fed's probably going to sit back on their haunches a little bit too. I wouldn't expect to see too much out of them for a few months.
Yeah, I think I share the same. I think the caveat, as always, when it comes to interest rates is what the inflation figures come in at. Every single month in the US, we get a CPI, a PPI, and a PCE figure. And then in Australia, every quarter we get much the same. Whatever those figures are is going to dictate their next move.
It is. And the central banks have got bands that they've got to keep inflation within. That's one of their primary objectives. But it's not just simply about managing inflation. It's ensuring a robust and steady economy too. So, it's not just, that's inflation, let's obsess about it. It is the major ingredient that goes into the rate cut decision or rate rise decision. It's the main one. But there are other things too, like ensuring that we do have a stable economy. And look, I think we've got a few challenges challenges ahead for us here in Australia. I think our resources probably will do quite well out of a weaker dollar because they sell their commodity in US dollars. But the flip side of that one is their major export market, being China, is also slowing down a little bit. So, there's a lot afoot here. It's one of those things you've simply got to watch. And unfortunately, what the right hand takes, the left hand gives in this instance. There are pluses and minuses. Net, hopefully it's fairly neutral and we can just get on with life without having to obsess about interest rates.
Indeed. Well, stay tuned. Thank you very much for the insight today, AB.
My pleasure. Anytime, Mitch. There you have it, guys. Make sure you like, comment, subscribe, and please do take your time to comment on this. We love seeing what your feedback is so we can engage with you and talk about this in far more detail. Look forward to hosting you next week.